right, folks, welcome back. We're going to be going over something that's pretty simple, very, very simple, nothing too hard. Draw on liquidity. It's not hard. Okay. That's if you learn from the wrong mentor. Yeah, it'll be hard, but you're learning from me. So nothing's ever going to be hard unless you have a certain question, unless I mess up while teaching, unless I do something on my part to where I don't teach it properly. That's the only way something is hard on this channel. Anyway, draw on liquidity. What is it? Draw on liquidity is basically you putting together a bunch of confluences and saying to yourself, based off of this, this, that, and this, price should go directly to this point right here. That's all you're doing. That's literally it. Now, you're probably like, okay, well, what's the concept of putting together confluences? Daily bias. That's assuming we're just, finding the draw on liquidity per day, in which that's what you're normally going to be doing because I'm teaching you how to day trade, not swing trade, not long-term trade, not even invest, not scalp, simply day trade. Well, kind of sort of scalping and day trading. It's the same thing because you're trading within the day. But anyway, daily bias is, again, putting together a bunch of confluences to get the direction of the day. To say, okay, based off of this, that, and that, price is going to go that way, in which price can only go two ways, up or down. So there's a 50% chance you'll be right or wrong. Simple, right? So your draws on liquidity. What can be draws on liquidity? You can do PD arrays, order blocks, mitigation blocks, rejection blocks, liquidity voids. What else? Let's see. Basically any other PD array, and then liquidity, like buy side, sell side liquidity. It can be short-term swings, intermediate term swings, long-term swings, um, long-term swings or term swings based off of open float. It can be a lot of things. But the one thing, listen to me here, the one thing that cannot be a draw on liquidity is fair value gaps. You want to know why? Here, I'll ask you one question. Do fair value gaps contain liquidity? Yes or no? You say yes? If you said yes, no. It's incorrect. If you said no, that's correct. Reason being, for example, this fair value gap here. I have to say this because some people will actually use fair value gaps as a draw on liquidity. I swear to God, I'm not lying to you. So if we use this fair value gap here, you're probably like, oh, but Josh, look, it dropped down into. No, no. Listen to me here. We know the three rules of the market. Okay. First, seek liquidity. Second, rebalance imbalances. Third, rebalance the equilibrium. Those are the three rules of the algorithm. Now, with fair value gaps, right? With fair value gaps, since this is a bullish fair value gap, meaning there's only longs here, only longs, no shorts in this range at all. Okay, pay attention to every word that I'm about to say. This has only longs and no shorts at all. No shorts. If price is hunting sell side by dropping, because that's normally what will happen when you're dropping, we're looking for sell side. Listen to me here. We're looking for sell side. Okay? Sell side. Are you listening to what I'm saying? We're looking for sell side. Does this fair value gap, specifically this bullish fair value gap, contain any sell side? No. No, it contains only buy side. Why? Because this is a bullish fair value gap, and anything within this range is only what? Buys. There you go. It's so obvious. It's right in your face. The definitions, you just got to put them together and say, oh, okay, that makes sense. Oh, okay, that makes sense. Oh, okay. You got to do that. That's what I had to do in order to figure this stuff out. So do not ever, 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 ever use a fair value gap as a drawn liquidity. Now, you can use fair value gaps to depict a drawn liquidity, meaning if you're expecting this fair value gap to get filled, you can likely see, where's my tool at? Oh, you can likely see this low getting taken after it fills that gap. Stuff like that. You know what I'm saying? You don't have to, well, no, not even have to. You cannot use a fair value gap as a drawn liquidity. There's no such, and I just hit my mic, you probably heard that, but there's no such thing as a fair value gap being a drawn liquidity unless it's a liquidity void, because that is a PD array that price can respect and bounce off of. You know what I'm saying? Okay. Just making sure. Now, let's actually put some confluences together and pick a random day. Let me, pick a random day here. Let's see. I'm gonna close my eyes real quick. Hold on. Right here. Okay, what's this day? March 3rd. Okay, this looks pretty nice. First off, we're not even gonna go to the higher time frames because I don't want to, confuse you. Not even, I'm sure you won't get confused, but I just want to minimize this video. I don't want to do too much, but still do enough to where you can actually learn. So here we go. Here we go. Here we go. So right off the bat, just in hindsight, of course, I can see that Monday jumped higher, creating a, what's that, a short term, well, no, really an intermediate term high. So we have this as a, where's my tools at? Normally I have them in this corner, but um, I just moved it around earlier for another video that I was recording. But we have this intermediate term swing, which is probably a long-term confluence, so price is not gonna, hit it for right now. And then we have Monday jumping higher, Tuesday dropping lower, taking out Monday's low. So that is a liquidity purge, and specifically Monday's low that formed in London. So we're taking out yesterday's London low. That is a liquidity purge, in which pre-market jumped up, retracing into what's this right here? Asia and London's expansion lower. So what you could see is, if you clearly want to go higher, you could use pre-market retracement lower to temporarily drop back down lower into pre-market's low to purge liquidity once again. Let me draw that out once again. There we go. Hold on. Liquidity purge. There we go. Now dropping down to, we haven't even done the liquidity part yet. Oh, I don't think I can go this far on the 5 minute. I don't think so, at least. Let me zoom out and see. Yeah. Oh, I actually can. Never mind. Okay. Now here we go. Dropping down to the lower time frame, starting at 8:30, right here. Let's see what happens. Right at 9:30, we purge pre-market's buy side, in which I think we take out this high right there also. Yep. So basically equal highs with pre-market's high. That's another liquidity purge. I'm not doing anything crazy right now. Nothing crazy. In which we also hit this. Is this a propulsion? Hold on, wait. Because we have, no, that's not an order block. No, that's not an order block. That's an order block, but I don't know. That's the singular order block. That didn't hit it, so that would be in, yeah, that would be an order block. Okay, just making sure, because I was trying to see if it was a well, yeah, no, that's a propulsion. You know what? Hold on, let me make sure. Oh wait, nope. Okay, I'm glad I looked at that. Yeah, that's a propulsion block. My bad. Yep, because you see how, let me zoom in here so you can see what I'm talking about. You see how that candle's wick breaks above that one right there. This bullish candle's wick right here. So it's a consecutive order block, two candles. So since that's an order block and that candle wicked into it, that means this is now a propulsion block, and it, closed bullishly. So that's a propulsion block in which price, dang, it ran through that. Well, okay, never mind. All that explaining for nothing then. All that explaining for nothing, but it did hit that rejection block. I do see that too. But it probably ran through that also. Oh, no, it didn't. So we have the rejection block, hits the rejection block, and, obviously rejects, drops lower, liquidity purge. Then we have a bunch of stuff here. Now, let's mark this out. We have well, really two fair value gaps that can get filled. Okay. And then we create the low at, what's that? The end of the 950 to 1020 macro. So this could be the low of the day, but we got to see what price wants to do. We got two fair value gaps here. I'm not going to mark it because I don't want to put any more drawings on here. We got fair value gap there. Those could get filled. So clearly the narrative is bullish right now. From what we're looking at and putting everything together, it's bullish. We do have a, what's this? Yeah, mitigation block right there. So it would be this high of the candle that would be expected to get disrespected. And if we disrespected that, you would likely see price running through up to that high there, or London closes high, in which it does. Oh, my bad. In which it does disrespect that. So the draw on liquidity could be, in which is way too close to it already. It could be London close, or listen to me. London close, or it could be London's high. That right there, London's high. Or if we want to keep going even further, well, no, that's literally it. London's high, yeah. It hits London's high, and that's really it. But even still, if you want to go further, let me go to the 30-minute. Hold on. If you wanted to go to the 30-minute, you could target London's high, then target that what's that? That short-term high right at this fair value gap. Now, you're probably like, I thought you said don't use fair value gaps to draw on liquidity. Remember when I told you if a high has a fair value gap right above it, which in this case is right above it because this is a, reach higher into buy side liquidity. So since this is a high and has a fair value gap right above it, it's likely that this drawn liquidity right there at that high is likely to get what? It's likely to get ran. It's likely to get taken, likely to get hit, if that's the word I'm trying to get to. But using just the confluence of the fair value gap, that would possibly be your highest point in which you can already see that it did hit that. So let me just mark this as liquidity. But if you want to mark it as your drawn liquidity, that's most likely your highest probability drawn liquidity for that day, in which it simply didn't hit it because there was a lot of expansion overnight. But if there was a lot of expansion overnight, we probably wouldn't even have that drawn liquidity anyway. So it in short, it wouldn't be a high probability target. But enough of me yapping. Dropping back down to the well no, the hour, deleting all my drawings and picking another day. Might oh yeah, we might just have a drawn liquidity. What happened here? Oh, dang, that's 9:30. What? I ain't never seen no beefy long candle like that during 9:30. Anyway, using price delivery cycles. Oh, I just went over this example in a price delivery cycle video. Well, the narratives arcana video, my bad. Asia expanded. Well, kind of I would say yeah, it expanded because it used the previous New York's consolidation to expand higher, in which in the same session it retraced, not breaking Asia's low. Then London accumulated well, it accumulated some more going into London, in which London jumped higher. Then we accumulated again, in which after this retracement, everything is supposed to be bullish, like just straight bullish, no matter if it consolidates or not, in which it does one, two, but it's still supposed to be bullish in general, in which it does show that bullishness. So just using price delivery cycles is like the strongest daily bias confluence you can have because it's literally the foundation of the algorithm. This is the cycle that price follows. That's why it's called price delivery cycles. It's come on, it's common sense. You get the point. So just using that alone, you already know the daily bias. That's it. You already know the daily bias. Pre-market jumps up a little bit, but majority of it consolidates. So you're likely going to see the 9:30 opening shoot through the roof. Well, matter of fact, through my screen as we can clearly see. So let's see. What am I supposed to be doing here? Oh, right, the drawn liquidity. We already got our daily bias. Now it's time to see where where price could potentially draw to. So obviously, looking back, we have Asia high, which was already taken during pre-market. Then we have this high, which was already taken during pre-market, and then all that other stuff was taken during pre-market too. So one thing we do have is this short-term high right there with that fair value gap above it. So we could target the end of that fair value gap too. Not saying it's a drawn liquidity. It's not a drawn liquidity, but it's simply a place we can target. The drawn liquidity where price is going to go is right there, but our target could be the end of that fair value gap because it's right above it. So if I want to mark the end of that fair value gap too, which will be up here, I could just, what, can I make this line blue? Let me see, hold on. Oh, I did not mean to draw that. I can make this line blue just to make it look like the fair value gap. Yeah, there we go. Now drawing this out. Oh, look at that. Amazing. Look at that. Boom, bam. Wow, then after price hit those targets, guess what? It started having, low probability price action. Okay. So you have to be able to, how can I say this? Get your money, but without like, I can't really explain it, but be able to get as much money out of the market as possible without putting yourself in danger. It's real simple. So it's not even just skill, but it's experience. Experience and time being in the charts. So me selecting this target right here and not going all the way up here, right up there. You want me to zoom in on it? Not going right there up to that order block. And secondly, that order block isn't even a target anymore because it got exhausted right here, jumped into it, dropped lower aggressively. So that order block is now exhausted. So I didn't even pay attention to that. This is the highest probability target you could take on that day. This is going to come with time, back testing, and experience. This isn't like, how do you do that? Like, is there like a way you do it? No, it's just simply understanding price, knowing where price could go, and even understanding your asset, how it moves. It's just stuff like that. So you're learning how to get your drawn liquidity. Now you just got to learn where your drawn liquidity will be, and that's something I cannot do. That is something that's totally up to you. You have to train yourself on that. So I'm showing you ways and certain things you can target, but you just have to find where these things are and basically put yourself in a scenario to where you know where to find those things. Get what I'm saying? So I'm trying my best to teach you that. This is a 15-minute long video. I should just cut it here because it doesn't need to be that long. Yeah, I should. Let me delete all my drawings. Oh no, I did not mean to delete my indicator. No, no, no. Don't want to do that. This indicator is very, very helpful for you guys. Which this is the only indicator I use. No other indicators. Other than that, it's just raw charts. Anyway, this is the end of drawing liquidity. I hope I taught you this well. And this should, I'm gonna humble myself and say should be insightful to your trading and your skills when it comes to these rigged and having to navigate these markets. And I'll see you in the next teaching. Good luck and good trading.